What is the 50-80 rule in trading? The 50-80 rule in trading is one of those deceptively simple concepts that can quietly transform how traders manage risk, expectations, and consistency. It doesn't rely on indicators, complex formulas, or advanced market structure theory. Instead, it focuses on probability, discipline, and realistic performance measurement, which is why it resonates so strongly with professional traders and long-term market participants. At its core, the 50-80 rule helps traders evaluate whether their strategy, execution, and mindset are aligned with sustainable profitability. It acts as a performance filter, preventing traders from being misled by short-term wins or random streaks of luck. In an industry where overconfidence often leads to account blowups, this rule brings clarity and structure. The 50-80 rule states that a good trading strategy should capture at least 50% of the available move at least 80% of the time, or alternatively, that a trader should aim to execute 80% of their trades correctly even if they only capture 50% of the potential profit. This framing immediately shifts the focus away from perfection. The goal is not to buy the exact bottom or sell the exact top. Instead, the objective is to consistently capture the meat of the move, which is where sustainable profits live. Markets are noisy, unpredictable, and emotionally challenging. Expecting perfect entries and exits is unrealistic. The 50-80 rule acknowledges this reality and rewards traders who focus on repeatable execution rather than heroic precision. Most traders fail not because their strategy is bad, but because their expectations are misaligned with reality. They expect every trade to work. They expect to capture the full move. They expect minimal drawdowns. When those expectations aren't met, emotional decisions take over. The 50-80 rule recalibrates expectations. It tells traders that being right enough most of the time is more important than being perfectly right occasionally. This mindset reduces emotional pressure, lowers overtrading tendencies, and encourages patience. By adopting this rule, traders begin to judge performance based on consistency rather than isolated outcomes. This is a massive psychological advantage in markets that reward discipline over ego. Just a quick reminder to please hit the like button and subscribe to the channel for more content like this. Also, visit us on the web at investmentees.com and use code BLOG to receive 20% off your next purchase. Capturing 50% of a move does not mean exiting trades prematurely or settling for small profits. It means identifying high probability zones where price is likely to travel and positioning yourself to benefit from the core directional move, not the extremes. For example, if a stock breaks out from consolidation and runs from $50 to $60, capturing $5 of that $10 move is more than sufficient. Attempting to squeeze out every last cent often leads to missed exits, emotional decision-making, and reversals that erase gains. Professional traders understand that markets give money in chunks, not in perfectly measured increments. The middle of the move is where liquidity, momentum, and follow-through tend to align. The second half of the rule, 80% consistency, is arguably more important than the profit component. Consistency refers to following your plan, executing your strategy correctly, and managing risk according to predefined rules. A trader who captures smaller portions of moves but executes correctly 80% of the time will outperform a trader who occasionally hits home runs but regularly deviates from their plan. Consistency compounds over time, while inconsistency introduces volatility into both equity curves and emotional states. This aspect of the 50-80 rule reinforces the idea that process matters more than outcome. When the process is sound, profits become a byproduct rather than the sole objective. The beauty of the 50-80 rule is its flexibility. It applies across day trading, swing trading, position trading, and even algorithmic strategies. Regardless of time frame, the principle remains the same: capture the most probable portion of a move with high execution accuracy. Day traders may apply the rule by focusing on the strongest intraday trends and exiting before momentum fades. Swing traders may use it to lock in gains before major resistance or support levels. Position traders may use it to scale out rather than attempting to time multi-month peaks. The rule adapts to the trader, not the other way around. Trading psychology is where most traders struggle, and the 50-80 rule directly addresses this challenge. By removing the pressure to be perfect, traders experience less anxiety, less fear of missing out, and fewer revenge trades. The rule encourages traders to think in probabilities instead of absolutes. Losses become part of the statistical distribution rather than personal failures. Wins are appreciated without becoming intoxicating. Over time, this mindset builds confidence rooted in discipline rather than luck. Another underrated advantage of the 50-80 rule is how useful it is for performance review and journaling. Instead of asking, "Did I make money?" traders can ask, "Did I capture a reasonable portion of the move? And did I execute my plan correctly?" This reframing leads to more honest self-assessment and faster improvement. A trader can be unprofitable in the short term while still trading well, just as a trader can be profitable while trading poorly. The 50-80 rule helps distinguish between the two. Professional traders, proprietary firms, and institutional desks thrive on repeatability. They don't need massive wins, they need predictable outcomes over large sample sizes. The 50-80 rule aligns perfectly with this philosophy. It prioritizes consistency, controlled risk, and process-driven decision-making. Over hundreds or thousands of trades, this approach produces stable growth rather than emotional roller coasters. Beginners may benefit the most from adopting the 50-80 rule early. It protects new traders from unrealistic expectations and encourages them to build habits that support longevity. By focusing on partial profits and correct execution, beginners develop confidence without exposing themselves to catastrophic losses. This foundation is critical for surviving the steep learning curve of trading. When applied consistently, the 50-80 rule reshapes how traders view success. Trading becomes less about excitement and more about professional decision-making. Over time, this leads to smoother equity curves, reduced stress, and a healthier relationship with risk. Traders who embrace this rule often find that profits improve organically as emotional interference decreases. They trade less, but trade better. Conclusion: the 50-80 rule in trading is not a shortcut to instant profits, but it is a powerful framework for building consistency, discipline, and realistic expectations. By aiming to capture a reasonable portion of market moves while executing correctly most of the time, traders align themselves with how markets actually behave. This rule shifts the focus away from perfection and toward probability, away from emotion and toward process. Whether you're a beginner struggling with overtrading or an experienced trader looking to smooth out your equity curve, the 50-80 rule offers a practical, timeless approach to sustainable trading success. In markets where discipline is rewarded and ego is punished, mastering this principle can be the difference between frustration and long-term profitability. Thank you for watching.